So let's now learn about what VCs are looking for in this evolving economic environment with our moderator for this panel discussion. Let's welcome Mr. Shubhanga Prasad, partner BetaPlus. And now I'd like to invite our esteemed speakers for this session. Mr. Aparajit Bhandarkar, partner Varanium Capital. Ms. Manasi Shah, Vice President Accel. Mr. Siddarth Pai, founding partner, CFO and ESG officer, 314 Capital. Ms. Vanessa Ho, co-founder, co-president, NUS Alumni Ventures. We'll be taking few questions at the end of the session, if time permits. So now moderator can take over from here.
Thank you so much. Good afternoon, everyone. And I'm Shubhanga. I have the privilege of asking questions today. And these are all the VCs. I'm actually trying to understand as well.
Once someone's asking us the question.
We always ask questions. We always want to hear you. So I think we have discussed about 4 or 5 broad points, starting from what are the sectors that are interested in, what is the TAM, but we will keep it conversational. And where I want each of you to start is the fintech or tech, sectors that are actually exciting to you guys today, and why. I think the why is more important for us. And I might butt in and ask more questions in case if you guys are skirting around the answer, yeah? Go for it. Mansi, you want to start?
Okay, I get to go first and use up all the good sectors, yeah. Hey everyone, I'm Manasi. I'm part of the Accel investment team. We've been historically investors in 25 odd fintech companies, financial services companies in India. Excited to do more. I think, look, it's like same, financial services as old and older than any of us. So over here, so I think it's different flavors to the same problems and as they evolve. So maybe a couple of spaces that we're spending a lot of time on looking for innovation. I think one is India is going to be a partnership-led growth story in fintech. So it is a convergence of banks, NBFCs, regulated entities, along with the best kind of digital innovators in the country joining hands. So very excited about enablement plays that are kind of win-win. There's some great examples in the portfolio. Maybe I'll use MoneyView as an example for those, yeah.
Give us more about what you're going to invest in, rather than what you have already invested in.
Sure. Okay, I think we have a good moderator here. So I mean, enablers, we're like scratching the surface today. So definitely if people are building good enablement plays, we would be investing a lot more. I would say enablement, maybe I'll make it more specific where I'm excited. I think credit is one of the spaces where banks hold licenses, balance sheets, a lot of the know-how, and then the customer experience, some bit of the data, and those things are coming from fintech partners. So I think folks that are building interesting infra layers for banks, NBFCs, are able to go sell it to them, which is the harder part, convince them to kind of shift out. So new age kind of cloud, LOS, LMSs, are very exciting. Looking at a lot around credit card issuance as well. I think credit on UPI is like, you think it's the most popular member of GFF. So it's like, it's all everywhere. So what are interesting kind of new age issuance systems that really, bring the right experience with a from a fresh thinking point of view. So infra's super interesting. The other area that we're very excited about is wealth, because I think there is, as India is shifting, towards, wherever, like, I hope we get there soon, but as we become a 5-6 trillion economy in a few years, hopefully, there are new segments that need personalization. So there'll be emergence of like, hey, look, if you if you're in this age group, and this is the type of like, there are interesting companies globally we see like Compound, etc., that are focused on, if you were a like startup ESOP holder and you came into wealth, we're a solution for you. And while that sounds niche, sometimes these markets like grow very fast and can be very interesting. So personalization within wealth is like one big other theme.
Infrastructure, wealth, personalization, infrastructure in the banking side is what you said.
Yep.
And Siddarth, what are you saying?
Yeah, sure. So I'll keep it a bit brief as well. So from a fintech perspective, one thing I'm more excited about, and one of the theses we believe in, is that every company can actually become a fintech company itself. Because if we look at it for that matter, the management of money is actually the most essential part of actually running a business. Too many businesses have failed because of the inability to actually manage their own finances. I think at the part we're seeing right now, where the friction to consummate the transactions come down to such a large extent, we've seen BNPL actually come in. We've actually seen numerous innovations that have actually happened. Now, those innovations have actually far outstripped the risk-taking or risk management ability of these businesses itself. So from that perspective, given the fact that every company can become a fintech company, it's not just actually enablement that becomes important. It's risk management and risk mitigation. 2008 happened primarily because of the lack of adequate risk management as well as risk visibility. So managing that entire piece is actually going to become crucial. Even during when ILFS happened, Yes Bank happened, etc., a lot of companies genuinely lost their principle in treasury management instruments. Now, what kind of tech or what kind of visibility you can build into that actually becomes a very important case. But it's not just financial institutions that actually get that, but even a regular company or trading company or something for that matter to actually look at it and say, look, if my supply chain ends up actually getting disrupted up here, there's another lockdown that happens here, a shipping canal ends up actually getting stuck, where am I going to see money come from? Where can I end up actually raising cash? So I think that's a very important aspect that's there. The second part that I believe is going to become crucial is the internationalization of India Stack and UPI itself. I think an important note for all entrepreneurs is NPCI is not going to be present in case you go into Southeast Asia, you go to Japan, you go to Middle East, etc. So the ability to monetize payments, which has been a bugbear, and I think has been a constant theme across all the GFF things so far, will actually end up actually coming up with that. And the first mover advantage of understanding the systems, going through integrations once before, and managing that entire piece. And it's not just UPI. It's going to be Aadhaar, it's going to be Jandan, it's going to be opening a bank account, fulfilling that entire piece, enabling credit on that. The Indian government is actually becoming the flag bearer for this. So who are the ambassadors who are going to go along with them and build that? That actually becomes a crucial play that very few people are actually looking at to a very large extent. So I think these are the two important themes that we're going to end up looking, and anything we end up finding in the space for that matter, that can end up actually translating business outcomes or business decisions into money, and just managing that better is one of the most interesting fintech plays that are there. So it's not just credit or anything else that's actually there. Finance breeds into every aspect of operations. It's going to be the smartest entrepreneur who can translate these business decisions, business outcomes, and business inputs into something monetary in nature. Whoever does that can actually end up actually rewriting the entire fintech playbook.
Should we be thinking of first building for India or building in India for the world? How do you look at your investment thesis? And do you want to kind of start with that? And maybe Vanessa, given your experience in the wider Southeast Asian ecosystem, if you both can touch upon, is it focus on India as a market, or should we actually start looking at building in India but for the global ecosystem? And what are your views on this proposition?
So just to add to Pranav's point, I think
Siddarth.
Sorry, very sorry. Siddarth's point.
Pranav will be happy, I guess, hopefully.
So you know, if you look at UPI, which is being exported, I think Indian companies who are probably doing, say, doing payment security, those sorts of infra plays which are doing something on UPI, which is sort of going to build in India, they have got that experience. And if you ask me, UPI is very different from, say, a Visa Master sort of setup. So that sort of setup will have a leg up when we go around the world. And Indian payments platforms will be exported because we are probably the best payment platform in the free world. Yeah. So effectively, that's going to get exported quite a bit. In fact, we are in our report which we are releasing, we have a lot of that which will come up also.
Amazing. And Vanessa, do you also? None of you spoke about Web3. Is that in the realm of consideration for any of your investors? I'm not talking crypto, yeah. By the way, that's not allowed. So Web3 is what I'm talking.
Yeah, I hope we're not walking on eggshells over here.
I am not, but some of them are.
So, my background is I'm probably quite Web3 native in the investment team, but we are also very conservative about deploying money in Web3 itself, even though we're on the operational side of Web3. So I think since 2020, 2021 craze to now, the thesis has shifted to looking at Web 2.5. And what that means is companies that are serving, like basically reaching the mass audience or helping either other businesses or consumers get into Web3. So I'll just name you two of the portfolio companies and why. One is AAA that helps businesses accept and make crypto payments and access the 40 million crypto wallet holders. And why we're behind that is because you essentially need the payment infrastructure in order for any companies to start monetizing their decentralized applications. And without that key piece, right, you have so much attrition and churn, and your mass audience, which is your wider market that you really want to acquire, will never be able to make money, firstly, or if not, tap onto a larger TAM. The second one would be trade together. I think even in this current climate, people will still put like maybe a fraction of their portfolio into crypto or in the next bull run, and that's what we are preparing for. So this company is the first regulated crypto robo-advisor in Singapore. And eventually, when people start being more confident or putting their more allocation of their portfolio into crypto, they want something as brain-free and brainless like a robo-advisor, which is what we already have with ETFs and a lot of robo-advisors platforms right there. So I think our thesis behind Web3 would be something that targets mass, and we're not just looking at the smaller crypto circle.
I think that brings me to a question, right? So many a times, big tech, even smaller startups, we all look at India TAM in terms of number of people, and obviously it's huge. We are the most populous country in the world, but investment decisions have historically been made by looking at the MAUs and the DAUs of the applications. Is that is that perspective still relevant from an investment standpoint for you? And what is India TAM, and how should startup entrepreneurs or even policymakers think about India TAM? Siddarth, if you want to kind of start.
I can do that. See, India is a country of 1.4 billion people, so everyone looks at it saying it's 1.4 billion people. I can get, let's say, I can access. It's all this very Excel top-down driven math, right? And let's say break it so much. These are the number of people who have mobile phones. These are the number of people who end up transacting on it or using UPI. These are the number of people with demat accounts. Here's how I break down my TAM. I'll take 20% of the market. It's fantastic if you're a consultant who's actually creating a project or actually hypothesizing, but from a businessman's perspective, it's a terrible way to end up actually doing that. I think one of the biggest things that fintech has actually done, if you look at fintech 10 years ago versus now, we've seen a massive TAM expansion that we haven't actually seen across anything else. We've actually seen the building blocks of accessing and participating in the financial ecosystem actually get democratized and go to a large number of people. But there is still hesitation in terms of people actually purchasing because you want to see value for what they end up doing. If you look at the entire thing about stock markets and stock broking, we have a thing about 8 crore demat accounts as of now. That's about 80 million demat accounts, for that matter, for a country of 1.3 billion people. We're still hideously low compared to the US, compared to Japan, compared to where financialization of assets have happened. But if you look at an asset allocation perspective from a typical Indian family, it was traditionally FDs, it was actually banks, it was actually gold. Now what we've seen is everyone said, let's actually move them to stocks, but you can't change generational behavior just in a few weeks, in a few months, in a few years itself. So I think what we're actually seeing now, the innovation we're seeing is people are no longer saying financialization only means stocks, means mutual funds, means all those kind of instruments. But let's actually start understanding the customer more and enable them to do it. So a large number of startups are now actually working in the FD space, saying, look, you love FDs, we're not going to debate that, but let me actually find you the FD with the highest yield and the highest risk-adjusted return. You actually like gold for that matter, wonderful, because it's tangible, you end up holding it. So let's actually create digital gold and end up actually managing that. So what we're going to see from a TAM perspective is we're going to see a large amount of, I would say, pockets of innovation end up actually coming over there, which over 5, 6, 7 years will end up actually contributing to the entire TAM as of now. TAM in India is actually a ground-up equation because it's a very new market. There are no equivalents to what you do. If you look at a Chinese person's portfolio allocation, majority has actually been into land, which is why Evergrande and China, Country Garden, etc., has actually fundamentally affected their economy to a large extent. For that matter, if you look at it from a person in the West, financial assets and credit makes up the largest chunk of the entire portfolio. But India is different. So you end up taking, India will become like US, India will become like China. these false equivalences have actually resulted in terrible investment decisions. India is not where China was 20 years ago, where US was 40 years ago, anything like that. India will chart an entirely different course. And the moment you end up taking these sort of templates from elsewhere and posting it in, and trying to actually financially engineer, reverse engineer your TAM, you end up failing. Run experiments, run pivots, talk to your customers. There's still a prevailing notion in India that people don't end up purchasing SaaS products, etc. We have a company called Cuckoo, where they've actually done tremendous. The first digital payment of a number of people was on that platform. Why? Because they saw value in it. And the value, mind you, is not in the hands of the engineer or the CEO who ends up actually creating it. You'll take immense pride in your product. Your customer has to see value in that and doesn't mind actually paying. So the moment you end up understanding what the customer will pay for, we have 10 billion UPI transactions. No one can make an allegation that India doesn't make payments. Yeah. India doesn't pay. You just have to understand the customer better. And you can't sit Geo World Center in BKC to understand what's happening in Bihar. It's impossible. And let's face it, the urban market is actually saturated to a large extent. But deepening and going in and actually understanding how these people invest, you're end up making fantastic, great products to end up coming. And I think those entrepreneurs now are slowly actually coming up. It's no longer just, I'll create another stockbroking app, I'll create something that will allow the top 1% or 1% to end up actually spending their money.
Totally agree. And I think that's great advice for people who are starting up, who are in the early stages. But Manasi, I'm looking at you, especially from your portfolio standpoint. You would have obviously invested in many of these considering their India opportunity, so to say. But I have also seen quite a few Series A plus, Series B plus kind of startups where they are now struggling to figure out where their next set of growth is going to come. So can you talk about the depth of Indian markets, especially from a B2B perspective as well? Because I think Siddarth did touch upon the B2C aspect of it. So if you can give your views on that.
Sure. I was just going to ask, saying, TAM is like such an overarching word. Each thing, like wealth, lending, you could go like infra, each has very different nuances. Like in lending, there is no TAM problem, but you have to manage risk and your economics and capital supply and all of that, right? So when you say B2B specifically, see in Accel, we've had, maybe I'll just zoom out, like B2B, what we mean is just selling typically software plus some services, right, offering, to typically what have been either enterprises, banks, NBFCs. In our encouragement is that if you as an entrepreneur truly think that the India opportunity is not large enough for your ambitions, again, everything doesn't need to be a venture scalable businesses, right? There are multiple phenomenal businesses in India that are like, call it 15, 20 million in top line, 5-7 million in profit, and it's like a phenomenal, you could actually do that bootstrapped or with very little capital. Assuming you want to get to what, quote unquote, we call like that venture math, right? That you get to about 30, 40 million in profits, or which typically translates into, in that 100 million to 150 million in top line. If that's not enough in India, try thinking global from day one. At least we've seen a little bit of a struggle on when, given especially in financial services, India's such a locally unique market, it becomes extremely hard in regulated markets to go global post facto. So Series B, and not to say that there aren't companies like entrepreneurs solve all challenges, but I'm just talking about the degree of friction that comes when you're adding that later in your journey. So we have companies like ChargeBee, for example, which is payments infra, subscription payments infra for software companies, global from almost day zero. There's another company called FalconX in the crypto space, global from day zero. So take that decision early on, and to Siddarth's point, be very honest to yourself. I think in India, B2B, at least the way I see it, is getting into an enterprise or a bank or an NBFC is one of the hardest things. So once you've done that, at least what we've seen is people are very smart about either rolling up other products. So once you have the distribution and the relationship, there's often inorganic growth that kind of fuels you, or there's very high product velocity, and you just, again, from day zero have to know that I can't make one product for one space, and that's it. In the US, you could like do that often, and it's like a 2-3 billion kind of market. Over here in India, often you have to kind of be on your feet, but what really helps you in B2B specifically is just having those like relationships, being an approved vendor for, let's say, a PSU. We have this company called Night Fintech. Took them like long time to break into the first public, and I think it's a common portfolio with you all, long time to break into the first bank. But once people see like 2 or 3 trusted logos, it like brings the next 4 or 5. So I think just having that patience and leveraging the distribution becomes really important.
So Shubhang, I think one thing that's also really important for an entrepreneur to also imbibe is actually patience and decadal thinking. If you actually just run simple math, you want to become $1 billion in 5 years. You start off, let's say, with 10 crores or 5 million or something. If you run the IRR, it's fundamentally unsustainable for every single business to end up actually reaching that. And to the point that Manasi actually made, look, there are genuinely fantastic outcomes to be made in case of 50 million, 20 million, $25 million in terms of revenue. That matter. It's still substantial. In dollar terms, it looks small. Translate that to rupee, it actually becomes large. We look at the Indian listed market as well, from a market cap perspective. We have innumerable startups who, if they listed on their valuation as of today, would end up being in the top 1,000 companies in the country in terms of market capitalization. And they're also going up against companies who've been there in the market, who've been historically profitable, and may end up surpassing some of these startups in terms of those metrics, in terms of more traditional investing metrics, which have actually become the norm as of now. So I think one thing that needs to become important is if your business has a fundamental glass ceiling, it's not a bad word. But your business can actually end up growing over time. If your entire market is, let's say, 40, 50 million as of now, that 40, 50 million may actually becoming 100 million. As you go through that journey, you'll understand, look, hey, these are the adjacencies I can actually get into. I can make these sort of inorganic acquisitions, end up actually scaling it up. There are numerous opportunities that actually exist. It's not a bad thing to end up becoming a 100 million company that's actually profitable. It's fantastic, honestly. And those 100 million companies can actually become far larger. Infosys took 25 years to actually reach 1 billion in terms of revenue. They reach the remaining next billion in about 2.5, 3 years. The hockey stick, there's a very long lead time for that hockey stick to end up coming about. Don't get frustrated, don't get impatient, start making rash decisions. Because in financial services especially, it's not just about tech, it's not just about your ALM, not just anything, it's actually about trust. If your customers can't trust you, if the regulator doesn't trust you, doesn't matter how innovative we are, everything ends up collapsing. I mean, you are rash in financial services. The best investors in the world are the ones who actually, or the best performing financial services company in the world, are the ones who've actually taken it slow. You look at a HDFC Bank, one of the largest banks in the world, the top 5 largest banks in the world, I think the largest bank in India also. They built it slow, they built it well. And that compounding ends up coming. Warren Buffett made 99% of his wealth after the age of 65.
But actually, that brings me to an interesting point, right? Which is, to be able to do it for such a long time, you either need investor capital or you need to become profitable. And obviously, finally, I started profitability conversations in 2019. I think Mumbai, I was part of the panel, it just came to me. And nobody was talking profitability back then. But clearly, there is some talk of profitability since 2022. What are your takes on how growth stage startups should be looking at? Are you talking about profitability to your portfolio companies?
So, basically, first to answer, I'll add to a little bit of the TAM story. I think the TAM in 2019, 2020, 2021 was different, and the TAM now is different. And TAM is what venture capitalists see. So unfortunately, thankfully, we don't have in the panel some of those venture capitalists, but there are lots of them who have given TAM numbers, and there are a lot of listed companies also. There are 2 listed companies in India. Both of them have managed to get capital based on TAM, and there is quite a few of these unicorns, decacorns, which are there, which have raised lots of capital on TAM, and now are trying to justify how they can grow into that valuation. But I actually feel that there is going to be very little chance that they will grow into the valuations that they achieved in 2021. And I'm making a very negative statement and probably controversial one, but I think there is a lot of those. TAM has been very oversold in India.
Mistakes learned, in a sense?
I hope so. To answer the question in terms of profitability, actually, for us, we didn't have much of a choice. We are just a small fund. So we assumed 2 things when we are investing. One is that you give this founder sufficient money for at least 24 months on the day you're funding them, either through ourselves or with the network that we have added to it. And second is that, in those 24 months, get to break even. In fact, I would say that in our portfolio of about 12, 14, I would say that at least half of them are close to break even. So we, as a philosophy, didn't have any option of, and so we never sort of invested in companies which were going to do this hockey stick growth, because I actually tend to agree with Siddarth in terms of, I've been largely from a banking culture. You look at compounding, you look at 5-7 years, and there you basically, funds in India are not 20 years, but 5-7 years, and then if you can compound anything at a decent pace, you'll.
And is it also, in some sense, sectoral and type of business that will influence whether to invest in a growth or whether to focus on breaking even? How do you?
So, I used to believe that, for example, you have some notions in mind. When we went to invest in payments, we thought you cannot be profitable in payments. But when we actually saw the numbers, payments is a highly profitable business. I actually, sometime when I speak to larger VCs, they ask me, how are your startups profitable? I actually want to ask, how are the startups which are much larger than us unprofitable? Because it's very difficult to imagine someone's making, like, say, 1,500 crores of revenue. I think you should be able to run your house within 1,500 crore rupees. After you pay the bank, say 1,000 crores, because that's what your interchange is. Balance, you got 500 crores. 500 crores is a lot of money to manage your team. I don't know how people are not breaking even. People ask me this question. I don't know how people are not breaking even. So if people want to break even, because there's so much funding that was available, people were finding opportunities to burn capital.
Fair. No, I hear you loud and clear. I think in essence, if you're actually anything more than 150 crores of revenue, you should start thinking profit.
It's not a choice. Let me be extremely clear about that. It is not in financial services, the expectation from the market, expectation from investors, and from the regulators, for that matter, is profitability. You can't have a financial system where there are entities that are actually not profitable, because going concern becomes a genuine issue. And if something collapses in that entire transaction chain, the entire chain actually collapses. It's not as resilient as what people actually expect it to be. That's why when we see when large financial institutions in the country have also gone down, there have been severe dislocation to operations. There have been unintended consequences of the highest degree. The expectation has always been that you end up actually turning profitable. And one of the ways to turn profitable for that matter is to actually end up managing operational expenses and corporate overheads. We've seen far too much bloat that has actually come into some of these organizations, where they end up saying, I'm going to hire for the next 3 years today itself. There's immense bench strength that actually sits over there. If you look at the IT services companies, they've managed the ability to end up hiring large number of people, will make sure they can monetize them as well.
That's fair.
There are no idle resources. So I don't think it's a choice. It's the expectation from fintech is for regulated financial services is for you to be profitable at the earliest. The moment you do that, your ability to expand business and increase and actually attract capital is far higher than ones who are not profitable. I think because of low interest rates, we've seen that sort of this well-founded notion end up actually being, I would say, put on the back burner. But it's become prominent as of now, and the expectation for all investors is simple. If you're in financial services, come hell or high water, turn profitable. Otherwise, move to something else like e-commerce or hyperlocal or something like that.
And what about fintech infra?
Yeah, I think, and just one point before that, see, I think it's like know your own business well, right? Like be very honest, we've said on TAM, be very honest, like understand the dynamics of your business. There are only these many business levers. There will likely be 2 or 3 examples before you to look to in terms of like, look, cost of capital only goes to like this, right? Like, and this is how much your customer you think will pay. Now, how much should your fixed cost be? So like know the business levers. The only nuance I'll add is there are certain models, once you look introspect, that need little bit of lead time. And in that, obviously, maybe it's okay to kind of take investment upfront, right? So if you're building tech infra, there is capex upfront, and you are a tech company, so you need to hire good tech talent. But look, if you are tech enabled, right, which is a lot of businesses in India, you don't need that like ex-Google, like with all respect to Google, like engineer with who's taken a 20% pay cut. Like so just know your business and build it accordingly. Credit card businesses have their own payback period. So like understand the payback like on your own business.
Yeah.
And then build it accordingly and bring the right partners on accordingly as well, right? For all, I mean, I'm coming from a venture point of view, but venture is not the right capital for all businesses, overall as well as in financial services. So pick the right partners as well that can get you to your best outcome for your business.
Absolutely. Actually, just coming back to financial services, I think one of the things is, given that it is a regulated play, regulator consequently becomes a very important cog in the overall ecosystem. And Vanessa, you come from Singapore, which has had a history of very strong regulator. And what do you see as given your investments in Singapore and in India, how do you view Indian regulations? And I want to understand if there are areas that you would like to have better regulatory clarity on before you actually kind of make your investments.
I think two things when we compare Singapore regulation, which is where a lot of companies incorporate and raise funds from. So we're not just looking at Singapore companies, but say companies from Indonesia, Vietnam, Malaysia coming in to incorporate and set up shop in Singapore. So that's where you mostly invest in versus here. I think one big thing is having like really close-knit conversations with regulators, which fortunately has been more happening more frequently. I think in the last few years, knowing that investors can't just be blindsided to the startups without looking at that. Firstly, you're talking about huge change in valuation play, right? Whether you get a licensing or not. And second is also we need to see what are the headwinds and tailwinds with the changing regulation. I think in Singapore, the policy change is quite quick, and I think same thing with India as well. So there were a couple of companies that we have invested in, especially in the Web3 space previously, that have just hit like a blocker and they immediately have to pivot or they immediately have to raise a bridge to save themselves to build new products. So those are some of the mistakes that we have made, not being so sensitive enough or not diversify enough because of regulatory considerations. I think also for companies that heavily rely on licenses, we started looking also at a team construct and whether they have the right hires who truly understand regulatory requirements or also have formal relationships with our central bank or monetary authority of Singapore. So looking at the team quite closely, whether they are looking for a hire like that or already have that, especially when the fundamental part of the business relies on specific licenses, is quite important for us.
Makes sense. Any other thoughts from the panel before I go into the last segment?
So regulations, I think I'll be very honest, RBI has done a fantastic job. I mean, 2008, I was in America and I was seeing what was happening. India did a great job preventing derivatives from becoming very rampant. We have taken the lead in banning cryptocurrencies. I'm sorry, no offense, but I think it's a Ponzi scheme. I actually think crypto is a Ponzi scheme, and I have been saying this for the last 10 years, to my detriment somewhat, but that's what I think. So RBI has taken the right approach in terms of regulations. In fact, sometimes we think that it is harsh, but let's say, for example, you don't want variances in the economy. In India, you give a loophole, there can be a lot of misuse of those loopholes. So in that sense, we've got a very good regulator. They take their time, and we've also been at the receiving end. You can take 6 months to get a permission to invest into an NBFC. You can take, SEBI can take 5 months to give me permission. But I do understand that that's their process, and I respect that. And I think that's the way it should be. And there are lots of startups which say that we've got too many regulations. I think if you want, that's the field. This is how the playing field is. If you want to play here, or else don't play. That's the way I look at it in India. And we've got to protect our economy, and the government is doing a good job on the regulatory front.
I think, actually being the regulator is actually one of the most thankless jobs in the world. Similar to being a moderator, actually, for that matter. Huh? For the simple reason that anything that does well in the market is actually kudos to market participants. Anything that's bad in the market is actually the fault of the regulator. So it's a very weird kind of place to end up being. And see, the regulator in the country also, there's a fantastic book on RBI, that's actually the history of RBI, that's available in various bookstores. I forget the name of the author. But that actually gives great insight into how the regulator thinks. The regulator thinks in decades, not in days, not in weeks, not in months. So when they look at something for that matter, they say, look, let's actually take a longer term view on this. This is a flash in the pan kind of thing for that matter. Let's see how it ends up actually maturing. And the kind of moves that they end up making for that matter are actually keeping in mind the long-term integrity of the financial ecosystem.
So do you
Would be-
think the regulator actually does a good job in explaining that view?
That is one of the areas I believe they can achieve. There are two areas I think they should improve. Number one is similar to what happens in mass, where there's dialogue with the industry. Now, the industry, there are bad actors in any industry that's actually there for that matter. Everyone in the industry is not a bad actor. Everyone wants to weed out the bad actors. But is unilateral action with unintended consequences on good actors ends up actually fundamentally eroding the entire ecosystem. So greater dialogue that's there with the regulator, I think, is important. And mind you, this dialogue can't be the regulator reaching out. Industry has to. If you look at the US, I mean, Sam Bankman-Fried's a horrible example, but it's actually appropriate here. He spent a large amount of his time on regulation for the simple reason that he went and said, look, if the regulator doesn't understand this, I have to go there and actually explain what my business model is. How many founders in India actually do that? For them, reaching the regulators, going on to Twitter, now whatever, X, or going on to some social media platform and actually abusing the guy. Regulations in the country are not written by what people actually say on Twitter or social media for that matter. There are formal channels to end up actually doing. It's a sign of maturity of the entrepreneur to go and engage. And the RBI should also do a job of actually explaining it. Exactly. I think that's important. Dialogue, regulations in isolation are actually end up actually creating uncertainty in the system, which creates negative drag. We need to have greater dialogue, greater transparency, and it's not a regulator-led initiative. It has to be industry-led. The lesser you do, complaining is not going to change anything for that matter. We've been complaining about roads. Outside, roads don't end up changing. The moment you take action and actually put that kind of effort, you do actually end up seeing change. It's effort, return on investment.
Perfect. So I think we have about 5 minutes. We can take audience questions.
Because we ended the conversation on regulations, and Siddarth, you been the member right now of SEBI APAC for the Uninitiated Alternative Investment Policy Advisory Committee. What do you think is going to be the impact of this committee, and what do you think would be the focus, and how would it impact the VCs and the entrepreneurs right now? So what policies and what would be the impact?
I think the role of the IPAC is actually fairly well explained in the SEBI website as well, is to make sure there's betterment of the entire industry, make sure there's stronger protection standards, make sure that investors are actually taken care of without actually adversely affecting the ability of fund managers to end up actually navigating and making that kind of investments. There's a heavy tension between what can be done versus what should actually end up being doing. So I think SEBI has a fantastic model in terms of getting industry members in to actually brainstorm with them, ask them questions, vet it all out before it actually ends up becoming policy. So I think that dialogue is something that should end up actually that will end up actually continuing. And I believe that this is the kind of model that other regulators, IRDI, etc., should actually end up adopting. Because the more industry participation, see, it's not the regulator nor the ruler. So the more dialogue you have, the greater it actually becomes. And industry does have concerns about unintended consequences because we live and breathe these regulations every single day. So I think SEBI's done a fantastic job on that. They will actually continue doing it without my membership, with that for that matter. We're all just variables in what is actually a well-oiled machine. So it's fantastic to end up actually being able to contribute to that from my side as well.
The one at the back.
So we have to follow the time. So
3 minutes.
yeah,
We still have 3 minutes
we
left.
also have a report release. Yeah.
Sorry, you can catch up with folks outside, yeah?
So any closing comments by you?
Thank you so much.
Thank you to the moderator, since it's a thankless job. So.
So clearly it
Regulator
is
and
not
moderator
anymore.
position is tough.
Clearly it is not anymore, so thank you. But lovely, and I learned a little more about how you guys are thinking. I also work with a fair number of entrepreneurs, but now I know where to route them if they have questions. Thank you. Thank you, everybody.
Thank you, everyone.
Thank you.